Today we're going to be demonstrating how GST works with RT reporting, and we're going to be doing that with a very simple organization just to make the mechanics behind the GST calculation extra clear. So when you enter the organization screen within RT reporting, you'll be presented with your list of organizations. And the first thing I'm going to show you is the default GST configuration for that organization, which is quite important because what we have as the default will then impact the forecasts and budgets. So we hover over the organization that we're interested in checking out the GST for. We click on the settings. First thing that you want to remember is that here within this detail screen, we've got the country of incorporation, which is obviously going to determine whether it's VAT or GST or sales tax or whatever it may be. Also has the GST frequency here. So this entity is on a quarterly GST basis. And that's quite important because later we'll see that better demonstrates the GST installments rather than a monthly organization or 2 monthly or whatever it may be that you have. We also have the GST accounting basis here, which is accruals, and this is all based on what's in zero for that organization. On the left-hand side, you've got chart of accounts, and in here, you've got a summary of all the accounts that you have. Once again, this is exactly what's in zero. You can see the accounts that are subject to GST and the ones that aren't. So for example, if we click on interest income, which is excluded from GST, we have a look in here and it says, oh, there's no GST, or the type of GST being applied is none, to be more exact. If we click on sales, on the other hand, this actually has a GST tax type of output, which means it's revenue that incurs GST. So quite important to get started there. Now, some organizations will have a default configuration screen. Because this is the demo organization, we don't have that, but I would recommend taking a look at the mapping of accounts and organization setting video. For the time being, it's important just to remember, if you do have any questions about how the GST is being calculated, chart of accounts is a good place to start. Now, the RT demo company, I've created a forecast earlier, which is very, very simple so that we can demonstrate how the GST is calculated. So I'm going to click on that forecast. This is a very simple rapid forecast. It's got 12 months of historical data and it's got 12 months of forecasted data. The first thing that I want to bring to your attention with respect to GST is that in the top left-hand corner, we've got the forecast settings. And in here, you can see the GST period, 3 monthly or quarterly. We can see the GST rate. Because this is the demo organization, you can't change the GST rate. It's based on the country of incorporation. Of course, the account mapping and organization selection settings video goes through how you can change the rate, although that wouldn't be very common. Importantly, we've got the GST accounting basis, which we saw in the settings. You can do cash or accruals. This one's accruals, once again, based on what's in zero, but you can change that. And the GST payment terms, which are set to immediate, but in Australia, for example, it's standard to have 28 days. Or if you're with a registered tax agent or practitioner, then you can get the extension, so up to 2 months. I'm going to demonstrate a very simple example with the 2 months so that we can see how this quarterly GST or BAS cadence works with the extended payment terms, and we can see how this, or what implications this has for the cash flow statement. Now, interestingly, you'll find for this organization, there's basically no expenses and there's no revenue. And I wanted to do that to make this example really, really clear. First thing that we're going to do, like we did at the beginning of the video, we're going to have a look at interest income. And it's represented slightly differently in the forecast visually, but fundamentally it's based on those zero settings. I've clicked on the cog, the settings cog, and under configuration, you'll see that this interest income has a line called subject to GST, and it's no. And that's based on the fact that it had none as its GST type. We could we could toggle this onto yes, but of course we don't. Just wanted to show you that, so we're going to leave it as no. Now, with the revenue, on the other hand, This is an Australian-based company subject to GST, and the revenue is a GST item. So by default, it's selected yes, and we're happy with that. So we've got these two revenue lines, and what I'm going to do is apply a very simple rule to say that this organization is making 1 million in recurring revenue in each month. And I'm going to save that. So recall, we've got the GST of 10% applicable. This is subject to GST, this revenue account line. And we've got a 2-month or extended GST lodgement period. So in here, we've got, we're currently in assumptions. We want to click on cash flow and then expand this. So you'll see, interestingly, this organization has named their GST sales tax. That's just the name of their account in Zero. So um, don't mind that too much. But this organization has revenue of $1 million. Importantly, all the figures are net of GST. So $1 million in revenue in the month of February, and that incurred $100,000 in GST. But recall that we're on a quarterly GST payment period. So we didn't have any revenue in the months of November or December or January or October. So therefore, we don't have any GST due at the moment. And so this GST, noting that it's on a quarterly basis, is accumulating. So we've got January, February, and March. So 200,000 in accumulated GST liability. However, we've got it on an extended GST lodgement basis. So the 200,000 in GST, which is due in this very simple example, actually doesn't occur until 8 weeks after the end of that GST or BAS period. We can demonstrate this by coming up to the forecast settings and selecting, rather than the extended 8-week period, we can choose immediate. And in here, you'll see, okay, that GST liability that was incurred from the months of January, February, and March of $200,000 is being paid in the month of March. Of course, if we came in here and we went to the assumptions and we went to the income line and we said, okay, we've got an equivalent amount of, or maybe not equivalent, let's just say we've got $100 in interest income each month. Obviously, this is not subject to GST. So that GST receipts component is 100,000. The interest income of $100. There's no $10 additional. It's excluded from GST, so we don't have to worry about that. This last line, which is called sales tax in this example, is giving you a summary of all the receipts GST in that period. So if we come back to assumptions, the same rules would apply for operating expenses. So accounts that are not subject to GST will be excluded from the GST calculation, and accounts that are subject to GST will be then included much in the same way, but rather in the GST or in the payments section of the cash flow, and it will have its own aggregate GST amount. So that is a summary of the GST, and thank you for watching.